Hello everyone, and welcome to the next webinar in our Startup Essentials series that we're being supported by Osler. So thank you for joining us today. I'm Michael Krastowski. I am AgeWell's lead on partnerships and business development, and today you'll be hearing from Ryan Unruch and Jennifer Humphrey, who are both here from Osler, and they will be talking to you about startup funding. So there's a lot of useful information that you're about to hear. And please do note that if you have any questions, Ryan and Jennifer have indicated you can drop those in the chat or Q&A at any time during the presentation, and we can always have them answered live. And if there's time left over at the end, we can have a bit more Q&A then. So with that, I'm going to hand it over to you, Ryan.
Great. Thank you, Michael, and very happy to kind of be here, and always love to kind of chat with founders and kind of talk about startups and venture financing. So just as a quick overview, Osler is a Canadian law firm. We have kind of the largest startup practice in Canada, represent about 1,200 startups across Canada. And on an annual basis, we put out kind of a venture financing deal study that outlines kind of venture terms in the Canadian market. The last one that we just published about a month ago covered about from 2020 to 2023, about $14 billion kind of worth of aggregate financings, 468 preferred share financings across Canada. We do kind of a detailed analysis of kind of what standard venture terms are in Canada. In terms of how we work with founders, we usually have a general kind of startup package that makes it very easy and kind of cost efficient for founders to work with kind of a larger scale law firm. And we kind of work on everything from kind of setting up two founders, incorporating, helping with financing rounds, all the way through, employment, commercial agreements, through exits, M&As, IPOs, et cetera. Just a couple notable transactions that we've worked on in the past couple of years. And let's get into it. So if you're looking to raise a kind of preferred share financing round, just one of the things you always want to keep in mind when you're kind of structuring your company and when you're kind of just setting everything up and entering into initial contracts is, what are investors going to be looking at? When you kind of get the first dollars in the door, what should you be mindful of? And so what are some of the due diligence considerations that you should always have kind of top of mind? And so the first one, and we could break this down into a couple different categories, is the legal structure of your company. We always tell clients when they're dealing with this, like, you never want to reinvent the wheel. Silicon Valley basically set up a structure in terms of what everyone's accustomed to in terms of your company should look in a certain way. There are certain rights that should be allocated to the founders, and there are certain rights that should be allocated to the preferred shareholders. To the extent that you start deviating from that, you're effectively just creating problems for yourself. And so you want it when, VC's coming to you and says, I want to put $1 million into your company. You want to make sure that you're going to make that diligence process as easy, as smooth as possible, because from their perspective, it's not that much money that they're putting into your company. They don't want to have to now engage a whole team of lawyers to have to go and understand your structure and why it deviates from what they expect to do. And so as much as you can make your startup look exactly as they expect it to look, you're just doing yourself a favor kind of for future financings. And so what does that mean? Effectively, the first thing you want to do is you want to structure yourself as just a general corporation in Canada. Typically, most people would set up as an Ontario corporation or a federal corporation, often referred to as a CB, Canadian Business Corporations Act, CBCA corporation. You want to have a very clear cap table that outlines exactly kind of who holds shares, who holds voting shares, whether they're commons or preferred shares, and who holds non-voting shares. Founder equity, one of the things that you'll want to do is, expectation is when a VC comes to kind of review your cap table is that all founders have something called reverse vesting on their shares. And so what that means is that notwithstanding the fact that you're the founder, you created all the IP, you came to the company, the expectation is that you're going to earn those shares over a 4-year period through sweat equity. And so effectively, if you got 100 shares, those 100 shares would come to you on day one. And then for the first year, nothing would vest. And then on the 12-month anniversary of you receiving those shares, you'd vest with respect to 25%. So in our example, 25 shares. And then monthly thereafter, over the next 36 months, you'd vest in the rest of your shares, such that, at the end of a 4-year period, 100% of those shares will be yours if you were to leave or get terminated from your company. And most founders say, well, that sounds kind of crazy. Like, I created the company. Why would I want to put these punitive kind of provisions on myself? I have to earn the shares for the company that I started. And the answer to that is like, when VCs are coming to your company, the expectation is that you're going to have some sort of vesting with respect to your shares, and they will know how much of your shares by the time you get to your seed financing, by the time you get to your A financing should be vested. And the problem is you want to start the clock against yourself. So if you say, okay, I started my company on January 1, I'm going to start the vesting now, where if you don't put it against yourself on January 1 and then you go raise a financing in September, your VC or your financing source is effectively going to say to you, I want to now put, restricted vesting from you, and we're going to start the clock in September, and you just lost 9 months worth of vesting to kind of hit your goal. And so it does sound counterintuitive, but you want to start vesting against yourself as early as possible in the process, so that, you just start that 4-year clock early. The other thing you want to be mindful of is promised equity. And we see this a lot of time, and it's often referred to as like the fifth beetle problem, is effectively, is there someone out there that you said, okay, come into the company, I'm going to give you some equity at some point in time, we're going to give you 10% of the company, or like if you join, you're going to get 15% of the company, and they have that in writing, like that's going to be a problem, effectively. And so first is don't promise anyone equity until you kind of have signed agreements with respect to it. And the second one is just make sure everything is documented. You just don't want someone out there with a claim that they come at the 11th hour once they find out that you've had a successful financing round, claiming that they own a percentage of your company. And the last thing to just be mindful of from a legal structure perspective is whether you qualify as something called a Canadian controlled private corporation, which at a high level just means you're controlled by Canadians. And the benefit of that is there's a bunch of tax credits that the Canadian government makes available to you. There are certain advantages with respect to option treatment for your employees and people who kind of work at the company. And so one of the things just to be mindful of at the end of the day is that, like, initially, to the extent that you're a business in Canada, to the extent that you will want to kind of retain that status, because it's very beneficial both economically, as well as for your employees to kind of maintain that CCPC status. That's something you always want to be mindful of. The next kind of legal due diligence thing that you should be kind of on your radar is that VCs are going to look at is who owns the IP. And so anyone who touches anything that relates to your product, to your services, to the development of it, you need to make sure that you have some sort of agreement that's signed from day one, from when, like, the day that they join the company or the day they start providing services, that says, as between all of us, I understand that the company owns this IP, and I will make sure that I sign every single document that's required to confirm that the company owns the IP. The biggest kind of like issue you're going to have is that, we brought on a couple of employees and we brought in some interns and they did something really key to the company, or they developed a service and we have no documentation kind of with respect to that. That's kind of like the nightmare scenario when someone's doing diligence, that you can't prove that you own all the IP, and then you have to go back paper some of the documentation, and then people have their hands out saying, well, if you want me to sign that now, 6 months later, I want $20,000, $30,000 to kind of sign that paper. And so the best time to put these documents in place is on day one. And the details of these things really matter. Not all kind of assignment documentation is created equally. And so you really have to make sure that you have the proper legal language in it. So make sure you get it kind of reviewed by a lawyer. The next thing on this list is an NDA, non-disclosure agreement or confidentiality agreement. If you're developing something proprietary and you're going to share it with someone, make sure that you get them to sign an NDA before you kind of, show them how it works, just to make sure that you kind of keep everything confidential if you don't have kind of other registered IP with respect to it. And then the last two kind of go together. You really want to make sure that if you're hiring someone, or if you're coming from a prior employer that does something similar to what your new business is doing, you don't bring anything with you. Like, the worst case scenario is you start doing something, your employer or your former employer finds out about it, and all of a sudden they're like, Mary and Mike created this while they were at my prior company, I actually own the rights to it. If you are at an existing job and you're trying to figure out, okay, I'm going to see if this startup works, I'm going to do this at night, like, make sure you're using your own computer, you're not using your employer's resources, you're not using any of their technology. Like, you really have to have a plan that you could show that you properly bifurcated everything and that you're working on your own resources. Nothing from your former employer was used, none of their prior IP, you didn't take anything with you when you left. These are things you're going to want to verify. And same thing with kind of university or government funding. If you're kind of working in a university lab, or you receive kind of funding from a hospital, you just want to make sure that none of the funding documentation or documentation with your university gives them a license to your IP, or something kind of through a back door where effectively they could come back to you and say, hey, we have a little bit of an ownership stake and you're going to have to buy us out with respect to it, or we have a perpetual license to kind of use your IP with respect to it. That's problematic. And the last two I'll just cover up super quickly. Employment law. if someone's an employee, you have to classify them as an employee. And what I mean is you often hear startups saying, this person works for me 40 hours a week. I tell them what to do. I give them all the instructions. They're effectively an employee. But for tax purposes, I qualify them as a consultant. Don't do that, notwithstanding the fact that it may be administratively easier. By the time you get to your kind of financing round, you're going to have to give your investors reps and warranties. And one of them is that you're in compliance with employment law and that there's no kind of fines that could potentially be levied upon the company for kind of misclassification of employees. And the last one here is security law compliance. This one's pretty easy. It's just make sure if you're ever issuing anyone equity, whether it's a SAFE or you're issuing them common shares, preferred shares, that person is entitled under securities law to actually buy shares in your private corporation, and that there's an exemption available with respect to it. So with that, I'll turn it over to Jen to just kind of walk through some of the high-level early stage financings.
Yeah, so thanks again for inviting us to speak. So at a high level, there are a few different methods for companies to raise capital. You have the common share, private placement, convertible debt, SAFE, and the preferred share financing. We'll be going through each one. But at a high level, I think the quickest, most easiest way to have money come in the door is kind of through that SAFE or convertible debt, which we'll talk about the pros and the cons of. Next slide.
Great.
So this chart is really helpful because it kind of gives you an easy visual in terms of some of the pros and the cons of each of the methods that I just discussed. So there's the SAFE, convertible note, and preferred stock. The most common, like I said, is the SAFE. You'll notice that the cost is relatively low, the speed is pretty high. Generally speaking, the documentation is relatively standard, so there's not too much back and forth. You may have some questions or asks specifically from an investor with respect to maybe information for their funds, et cetera, that they'll have to abide by. But otherwise, this is usually the quickest way to have money come through the door. At this stage as well, it's important to note that there is no dilution as the shares aren't actually issued. So you'll have the preferred shares or the common shares, whatever you have currently issued, you'll have, generally speaking, an equity incentive plan, which can be used to incentivize employees of the company to continue to provide services for the company. And then the SAFE is kind of in its own little cloud over here, which will convert at the time of a price round. The next vehicle that you could use would be the convertible note. Similar to the SAFE, it's also relatively expeditious in terms of time. You can get rather complicated notes, whether or not there's security that may be actually, implemented to secure that debt, then something like that, or a general security agreement, et cetera, that will generally delay things from an approval and kind of completion perspective. The last column there is the preferred share financing. This is generally, as you can see, the cost is generally the highest. And the reason for that is that the round sizes are generally bigger. So if you are raising perhaps something $3 million and less, generally speaking, companies that we work with will opt for either a SAFE or a convertible note, just because of the time that it takes to actually implement the preferred share financing. Generally, there's deeper diligence. The investors' asks may be higher. So there's a lot of different considerations that companies should pay attention to when they're kind of deciding what might work best for them at that stage. So maybe Ryan, we could flip to the next slide.
Wrong button. There we go.
So again, like which form of early stage financing is right for you? As I mentioned, there's quite a few. The biggest consideration, I think, for me and when I'm working with companies would be the speed. When is payroll due? How quickly do you need this money? And kind of do you have current investors lined up? If it's more of a bridge round, like I said, kind of under that $3 million mark, then generally speaking, a SAFE or a convertible note might be the way to go. The other thing too is depending, like I said, on the investor base, it can sometimes be difficult for an investor to set the valuation. So typically in a preferred share financing, the actual price per share will be calculated based on the valuation that the investor sets at that time. Sometimes with strategic investors, for example, they're less likely to set a valuation. So it's important to know kind of who that investor is and what they're comfortable with actually doing in the company's timeline. The next point is this round of investment, a bridge to a larger round. We kind of just talked about that. Like if it's a smaller check, then probably a safer convertible note. What degree of leverage do investors have? That will also dictate kind of whether or not, the specific asks, like I mentioned. So there's generally two things that founders care about. Number one, their cap table and dilution. And the second is really control. With respect to control, depending on the size of the check and the investor's leverage, or whether or not the company sees value from a strategic perspective to have them in the room, providing advice from an advisory perspective or a board seat, oftentimes that will be something that may be asked for. So it's just kind of important to think not only of the check, but also in a broader relationship, how might this impact my relationship with the investor going forward? And the last is really, do you have a preference for lead investor? So picking a lead is incredibly important. Certain actions that the company will take throughout its life cycle will depend on and actually require the consent of certain investors at times. For example, if it's a preferred share financing, generally speaking, investors will ask for certain fundamental changes, such as taking the business another direction, amending the shareholders agreements, the bylaws, the articles, etc. Anything that's really core to the business will generally require kind of preferred share approval. And for that reason, you want to pick a lead investor that not only you have a great relationship with, but also that can provide you kind of that guidance and actually, be willing to work with you and understand the company's needs. Like I kind of alluded to, the board seat may also be something that the lead investor may ask for. So if they're going to be in the room, you want to make sure that you're comfortable with having those conversations when times are good and times are bad. So the next, like I kind of alluded to, there's several different forms of early stage financings. The first is common shares. Depending on the councils, we sometimes see this when inheriting a minute book from another law firm. You'll see that investors will actually purchase common shares, which rank on the same, like pari passu with the founders. So there's no preferential treatment that may be afforded otherwise to a preferred shareholder. Again, the value is set. An investor's coming in and saying, hey, I'll buy 100 common shares for $1 a share. This becomes really important from a 409A perspective. So effectively, companies generally will want to incentivize their employees, their consultants, their directors, officers, etc. And it will be important to do so using options or shares. When you actually set that valuation or with that value, how much do those people have to actually pay in order to either purchase the shares or exercise their options will generally be determined by an independent valuator. Usually we call this a 409A. Though this is a US construct, it's widely adopted in Canadian companies as well, because an independent valuator will say, hey, this is the value of your shares. And so long as shares or options to purchase shares are issued at fair market value, then it generally discourages kind of adverse tax consequences from the hands of the holder. So issuing common shares for a set price can become problematic from a valuation perspective because you've had that third party actually ascribe a value to those shares. So it's important if you are going to be issuing common shares, which generally speaking it's not our advice, just make sure that you kind of understand the implications with respect to that. In terms of documentation and common investor rights, you'll have a simple, or you could have a very complicated share purchase agreement with multiple representations and warranties given by the company to state kind of what the actual circumstance of the company is or isn't. Like I mentioned, all holders of common shares will have equal voting rights. They rank pari passu, so they're treated equally with the founders. And again, like there could be specific asks from the investor, such as a board nominee or information rights. Information may be, financial statements or the ability to ask management questions throughout the year, inspection rights, going and actually attending the company's offices. So it's just important to kind of understand not only the check size, but also kind of how all of these implications fit into the broader spectrum of the financing.
Great. And just to go back to kind of that valuation point. So the way that kind of shares work is if you were to pay out a company that had preferred shares and common shares, first the preferred shares kind of get their entitlements, and then the residual value of the company goes to the common shares. And so realistically, all things being equal, you would pay more for a preferred share than you'd ever pay for a common share because they get paid first effectively. And so when you normally go out and you get a valuation, if someone paid $1 for a preferred share, the valuator usually come back and say, okay, we could justify that the fair market value of one of your common shares is 30 cents as opposed to $1. And so you have a bunch of people who are joining startups, they're getting a below fair market value salary. So maybe they could go out and they could join Microsoft or some other company and make X dollars. They're going to take significantly less to join a startup. And the way that you compensate them is you give them equity under your option plan. To the extent that you could give them a really low strike price, that kind of incentivizes them that their options would be in the money in connection with the financing round. And so the game that you want to play is you always want to get kind of the lowest valuation possible with respect to your options. To the extent that you do a common share financing round, it's very difficult to say that you just raised a common share at $1 a share, and you want to kind of have a valuation with respect to your options, which are common shares, at a lower price. And so by doing a preferred share financing or one of these other instruments, it really lets you kind of create that split between the value of a preferred share and a common share to justify kind of a lower valuation with respect to your options, which is a huge incentive to your employees. So moving along to the next kind of structure is a convertible note. And we'll talk about kind of convertible notes and safes at the same time, because convertible notes and safes have many of the same features. The big distinction between a convertible note and a safe is that a convertible note is debt. So if you're looking at your balance sheet from an accounting perspective, convertible note would qualify as kind of, a liability on your balance sheet. And if the company were to be liquidated, the convertible debt gets repaid first. And then if there's any residual amount, then it goes to your shareholders. So if you had preferred shareholders, it would next go to preferred shareholders and then the common shares. The way that convertible debt or a safe is kind of put in place is there's a bunch of different features that get negotiated. So one of them is a valuation cap, which we'll come back to in a second. Another one is a discount, and sometimes you have both of those features. And so typically what you do is you say, okay, I'm going to raise $1 million round, and let's say it's a convertible debt round. You have to figure out when is that note effectively going to convert. And so the note will typically convert at your next qualified financing round, which is generally just defined as your next preferred share financing round. And maybe there's kind of a minimum dollar threshold. So where you raise at least $2 or $3 million. And then the question is, at what price does your note convert? And so the features are, you could say, subject to a valuation cap. And so a valuation cap is not actually what you think the valuation of the company is today. It is kind of some proxy for an upward bound of a valuation before your financing round. And so maybe if you think your company is worth $10 million today, and by the time you get to your first preferred share financing round, you think it's going to be worth $20 million, maybe you choose kind of, $15 or $18 million. And so the idea of a valuation cap is if things go really well, and there's a great return with respect to the company, I'm still going to convert at my valuation cap. So I kind of have protection from a dilution perspective that no matter how high your valuation is in your next preferred share financing round, I will convert based on this fictitious kind of valuation cap that we've agreed to. And then the other feature is a discount. And so let's just say in your next preferred share financing round, everyone's paying $1 per share. And if your convertible note has a 20% discount on it, in that instance, you would convert at 80 cents per share. So you get the same shares as everyone else in your preferred share financing round, but you'd be paying 80 cents on the dollar because you took the risk of doing this the convertible note financing kind of earlier before it got de-risked and they did kind of this preferred share financing round. And sometimes, you could have a security that has both, where you get the better of, I get the lower price between a valuation cap and what I convert at based on the discount. And then there's a bunch of other features you could kind of put in between, like maybe it's not a qualified financing, it's another type of financing, or if there's a change of control of the company, kind of what are my proceeds? And so there's a bunch of different rules in terms of what happens to these convertible notes. But the main idea is the expectation is when you take a convertible note or a safe, in the next 12 to 18 months, the company is going to raise a preferred share financing round, and these people are going to convert into the same security that is issued in that financing round. You often see also a lot of incubators may come with some sort of equity check associated with them. So Y Combinator is a perfect example. Y Combinator would often give you a safe, which we'll get to in a second, where it says, okay, on your next financing round, our safe in exchange for $250,000 or $500,000 will convert into a certain percentage of your equity, is another way to do it. And you often see incubators basically just say, like, we're giving you a fixed amount of money, and that amount of money is going to guarantee us a percentage of your cap table. And one of the interesting things is, with respect to both a convertible note as well as a safe, is that they could either be what's called a pre-money note or safe, or a post-money safe. And we don't have to get into the technical details with respect to it, but essentially the investor prefers it to be post-money. And the reason for that is you could kind of get an approximate understanding of what percentage of the cap table that note or safe will convert into before your next financing round. And so a perfect example is if you have a post-money safe, for example, and someone gives you $100 and the valuation cap is $1,000, they'll end up with 10% of your company effectively as of immediately before the financing round, the way that the mechanics work under the note. And so with a post-money valuation cap, people could kind of get an approximate understanding of how much of the company you're giving up in the financing round. And then one other kind of thing to note with respect to convertible notes, the standard is, for the most part, is that they're unsecured, meaning that they don't have kind of a security interest or any lien on your assets. In some kind of examples in later stage financings where there's a lot of money coming in, sometimes the investors will ask for a security interest, which makes the whole process, much more difficult. But it's just something to keep in mind. And then a safe, just by way of background, is pretty much a convertible note, but with two key exceptions. One, it doesn't have a maturity date associated with it. So kind of a standard maturity date on a convertible note is 18 months, where if you get to the 18-month period and you haven't done a financing round, there is a potential theoretical situation where you actually have to repay the money or go bankrupt if they demand it, and repay the amounts that people kind of lent you under the convertible note. Where for a safe, if you don't achieve a financing round within a fixed period of time, it just stays outstanding kind of in perpetuity. There's no ability to kind of demand repayment for a safe. And the other thing where a safe kind of deviates from convertible note is that there's no interest on it, where a convertible note would have interest on it, the standard being about kind of 8 to 12% interest. No interest kind of accrues with respect to a safe. And as a result of that, on your balance sheet, instead of qualifying as debt, a safe would qualify as equity. In terms of the background, and safe stands for a simple agreement for future equity. And it was developed by Y Combinator, which is an incubator out of the US, because they realized that there are a bunch of people putting relatively, small checks into companies, and there was no standardization across the industry in terms of how people were putting that money in terms of what the terms were. And so they basically decided, like, we're going to come up with something that's standardized, where there's like 2 or 3 things that you can negotiate, and the entire industry is going to use this because it's just going to become, very standard. Everyone's going to know how to convert these things. Everyone's going to know the terms. They're very short, they're fast, they're cheap to put in place, and it's just kind of took off. And it's kind of ubiquitous within the industry. And if you were kind of raising a small round anywhere from kind of like $500,000 up to $3 million, like, we would not recommend that you do a kind of formal preferred share financing. We'd recommend that you do kind of a safe or a convertible note financing, just because it's so much faster, it's so much cheaper, it's widely accepted by all kind of VCs in Canada, in the US, and everyone's familiar with the documentation. And so it really does kind of help you get money in the door a lot faster at a lower expense without giving up too many rights. Sometimes in connection with both a safe or a convertible note, the investors will negotiate a side letter. And a side letter may say, we get certain financial information, or when you kind of complete your first preferred share financing round, we get preemptive rights, which means they kind of get the right to buy more shares in the next financing round, is an example of rights. But kind of the world is your oyster when it comes to side letters. Like, they might ask for a board seat or an observer seat or something to that effect. But in most safe rounds, people just kind of take the safe, and that's basically it. You're taking kind of smaller checks. And the one other thing just to generally keep in mind is, all things being equal, you're better off taking a few larger checks than a lot of very small checks. In Canada, you always want to qualify as something called a private issuer. And one of the conditions to qualify as a private issuer is that you have less than 50 shareholders other than employees, or former employees. And so as a result of that, if all of a sudden you go out and you issue $10,000 safes to 100 people, by the time you go convert into common shares, you no longer qualify as a private issuer, which has a bunch of just administrative annoyances with respect to future financings. And so all things being equal, instead of taking $10,000 checks, see if you could take one, $100,000 check to kind of get to the same amount. Just some interesting stats in terms of kind of where people are using this. Like the SAFE, this is US data from Carta. Carta is a cap table management platform, and pretty much like all US startups use it to kind of monitor their cap table online. And so they have all sorts of data in the background in terms of what these companies are doing, in terms of financing rounds, and how much money they're raising. And so they're just a great repository, and they publish for free all of this information on their website on a quarterly basis. And in terms of kind of pre-seed or early stage financings, like the SAFE is by and large, as you can see from this, like the dominant way that people raise financing rounds in the US and Canada, I would say is the same. And so if you were to take a look at this, for standard pre-seed financing rounds, like almost 90% of them are done on SAFEs, and a de minimis number are done on convertible notes. Convertible notes are just more complicated, they're more investor friendly, and they cost a little bit more to put in place. The other thing I thought was interesting, kind of at looking at their data, is effectively it is somewhat industry specific. And so if you were to take a look, which may be relevant to this cohort with respect to kind of the age well cohort of companies, is medical devices. I think due to the complexity of it, who the investor base is, the higher risk associated with it tends to stray more towards convertible notes than SAFEs. But for kind of general standard startups, it's like you could see the black line. It's like predominantly SAFEs is kind of market standard, and that's in the US as well as Canada. We spoke briefly about kind of the distinction between a post-money and a pre-money SAFE. And again, you can kind of see the trend over time, where originally everyone was transacting on what was called a pre-money SAFE. The downside to a pre-money SAFE is if you do, let's say I issue you a pre-money SAFE today, and then I issue you, 6 months from now, another pre-money SAFE at a different valuation cap, each round of SAFEs dilutes the other SAFEs, where post-money, there's no dilution of subsequent convertibles before a preferred share financing. And as a result of that, the market has completely shifted towards post-money SAFEs. It's 85% of all kind of convertibles of SAFEs that are issued in the US are post-money at this point. It's actually even hard to find the pre-money SAFE template on the internet at this point. I was looking for it before this. And then one of the questions is, and I think Jen touched on this, a lot of questions we get from people is like, what's the inflection point where I should be thinking about, should I be raising on a SAFE or should I be raising on a preferred share financing round? Like at what point does it justify the cost of doing a preferred share financing round and giving up board seats and giving up all these rights and having reporting obligations in terms of having to produce financial statements and give those to my investors? And typically, like in the US, it's about 3 million US is kind of the inflection point. In Canada, it's probably closer to like 2.5 million when people are, starting to consider whether they should do a preferred share financing round. But, we've done $100 million SAFE rounds. We've done, $250,000 SAFE rounds. So it really depends, and it's going to be company specific. But usually from a founder perspective is like, you should be thinking that if it's kind of below that 3 million mark, you should be pushing people into a SAFE or a convertible note, as opposed to bearing the cost associated with doing a full preferred share financing round. And with that, I'll turn it back to Jen.
Yes, so just jumping back to kind of the four, like we talked about, the four vehicles that you could have raise financing. We talked about the common shares, convertible debt, and SAFE Ryan went into, and now we're at this final stage of preferred share financings. So like similar to the common shares, and in this event, the actual security that will be sold is also preferred shares. So an investor will come along and actually set a value to that share based on the pre and post money valuations that they arrive at, much usually from high level initial sets of diligence. At this stage and upon closing of the preferred share financing, there will actually be dilution at that point because shares are actually purchased, similar to the example of the common share purchase. The documentation is largely the same. There may be additional representations and warranties with respect to the subscription agreement. If there's something like the company may have litigation or it may have a debt facility, et cetera, that's something that usually will be required to be disclosed. And the big reason for that is because if you think in terms of priority, debt generally comes first in terms of, I always think of like a bus. So if you have, if you picture a bus, you have debt and debt will get off the bus first. So as a result of that, usually that takes priority, and next you'll have the preferred shares and then common shares. So it's important to understand why preferred shareholders will actually want to know about this and be attuned to kind of the company's financial state. Generally speaking as well, there's also something called downside protection. Usually we see the original 1 times the money back. So if an investor purchases preferred shares for $1, usually they'll get their money back first. And I think that's, just like we kind of mentioned, downside protection, they're taking the risk on the company and they're having a senior security. With respect to anti-dilution, usually they will also want the protection that if the company were to issue a security or a preferred share for a price that's lower than what they paid. So if they came in for $1 and a share is subsequently issued for 95 cents, they want the protection that there will be a price adjustment with respect to their priority and the value of their shares. So they may get kind of a bump up based on that. Preemptive rights. It's sometimes also called right of first offer. So if the company issues any new security, such as a safe, a convertible note, additional preferred shares, et cetera, usually that investor will want kind of the first kick at the can, and the right to participate with respect to that. Rights of first refusal, that's any time that there's actually a security or a share that's actually issued. Say Ryan is on the cap table, he's a founder, and he wants to sell the shares, then certain preferred shareholders will ask to be have the opportunity to purchase those shares that are being sold first. Drag along and co-sale rights in certain instances. If Ryan as a founder is offered, the opportunity to sell his shares to an independent third party, then certain investors will also want to participate in that. I'm appreciating that there's a lot on the slide, so I can pause there if there are any questions with respect to preferred share financing so far.
None in the chat.
Okay. Yeah, and then I guess, like we kind of mentioned, depending on the size of the check and kind of the preferred shareholder, they may also have specific asks with respect to information, such as receiving copies of the financial statements, a board seat, maybe not having the right to actually vote in those board meetings, but the right to actually observe. That's called an observer seat, and certain shareholder vetoes with respect to potentially raising additional funds or capital by the company. They may want a specific veto on that. So it really largely depends on kind of the state of the company, how quickly they want to raise, how much they need the money, how much pushback they can actually exert towards the investor. And generally speaking, preferred share financings also take much longer. So you're kind of looking at least a 2-month kind of window from the time that the term sheet is signed to actually closing, depending.
And just to pause there, like in terms of the basics, like there's all these rights, and you're probably wondering, like, how do I necessarily know which ones I give, which ones people should be asking for? Is when you find kind of your lead investor with respect to financing, you talk to them, they're excited to kind of put money into your company, and you effectively decide, okay, we're going to do a preferred share financing. There are model documents, which in the US are called the NVCA documents, which stands for the North American Venture Capital Association. Canada has Canadianized versions of those called the CVCA, which is the Canadian Venture Capital Association. Standardized documents that kind of outline, how the documents are going to be set up, what the standard rights are. They even have kind of a form of term sheet. We don't recommend just using the ones that you pull off the internet, because there's a lot of stuff that gets negotiated in these, but effectively there's a standard set of rights that people are going to ask for. So if you're going to kind of a traditional venture capital source with respect to money, and they're agreeing with you that they're going to do a preferred share financing round, there's kind of a foregone conclusion in terms of what rights are going to go to certain shareholders. Like there's a bunch of negotiation points around the margins in terms of, who gets which rights and, what vetoes they're going to have and what you're going to have to get their approval to do. But for the most part, by and large, the general sense of the rights in terms of what they're going to get is kind of predetermined as to what the package of rights that are available to them. And then you negotiate that in a term sheet that they would usually deliver to you. And when you sign it, you then kind of your counsel would prepare the documentation. And then as Janet mentioned, they'll do due diligence on you. And over kind of a 45 to 60-day process, you'll go through the whole process, you'll agree on documentation, you'll get the approvals, everyone will sign it up. And then once it's signed up, they'll send you the money, you'll send them the shares, and effectively will now be shareholders that have all the rights that are listed here. And Jen, I don't know if you want to cover this one. I always find this an interesting slide that we get kind of questions from founders is like, how much of my company should I expect to give up at each financing round? But
yeah, so happy to jump in here. So you can see from the Series A, it starts higher, like i.e. you'll suffer more dilution at the earlier stages. So you can see there Series A is about 20.5%. And then by the time you get to the D, it's usually about 12.6%. And largely this is just because the valuations are larger, the cap table is larger. As you continue to progress, there are more kind of stakeholders. So the natural progression is that the largest dilution is suffered in the earlier.
Yeah, and like one thing you want to keep in mind here, and like we've seen this happen a couple of times, is people go out without lawyers, they kind of pull a safe off the internet or a convertible note that they find online. They don't really give it much consideration. They put a valuation cap on it, and then lo and behold, they get to the preferred share financing round and they just gave up 40 to 50% of their cap table to their convertible note holders or their safe holders because they didn't kind of model it out. They didn't build a pro forma. They weren't kind of thinking about it, and all of a sudden, they have what we usually deem as an unfinanceable cap table. And so, we've had a lot of situations where someone has, great idea, great founder team, great technology, great IP, and then they go shop it around to VCs, and VCs basically say to them, like, I love the company, love the team, love what you're doing, but I won't put a penny into this because you have an unfinanceable cap table. And what that basically means is the founders don't hold a large enough percentage of the equity. And so in that instance, they're like, okay, if we look at this table and we come to the first round and we're at the seed round and the founders only hold 20 to 30% of the company, I know in the next round, they're going to have to take another 20% dilution minimum. And then someone else is going to have to take 16%. And then how do I know that this founder team that's going to end up with 1% of the company is going to work 24/7 around the clock to get me my great returns in respect to this investment? There's not enough incentive, which means at some point in time, we're going to have to give them a top up, which is going to dilute me down as an investor. And so they're just looking at this saying, like, there's no way for me to get the economics aligned so that the founders are going to spend every waking hour trying to make this into the most unbelievable business that's going to earn me great returns. And so you have to be very careful. Like we always tell founders, like there's two things that you have to be mindful of from the minute that you wake up until the minute you go to sleep. One is like, how dilutive is an action that I'm about to take, and how much of the cap table am I going to own? And second is governance. Am I giving up too much governance to a third party? Am I giving up control of my board? And we'll get into this in a second, but like in our deal study, one of the things that we track is, well, what is the composition of board throughout various rounds? And we look at, how many common directors are there? How many preferred directors? And when I say common director, I mean founder. And usually the inflection point is when the founders kind of lose control of their board is the B round. Well, if all of a sudden, the preferred shareholders or external investors end up at your seed round controlling your board, well, they could fire you as CEO and kind of take back some of your shares as a result of it. And so governance and kind of dilution are the two things as a founder you have to be hyper focused on and like spend a lot of time building out pro formas. Like the lawyers that you're working with should be able to, build it out for you and say like, okay, like let's model this out. Like if you do a round with safes and then you do your next preferred share financing and this is the valuation you get and let's test different scenarios. How much are you going to own on a fully diluted basis with respect to it? It's really, really important to kind of understand ownership because it's not only going to impact how much return you get kind of on a potential exit, but it's also going to impact kind of whether investors are willing to invest in the company. Sorry, Jen, you want to do this one as well?
Sure. So I think we kind of talked about this just briefly at a high level, but just the median times between the rounds. Overall, you can see that it generally takes longer for, BC stage. And I think the big reason for that is depending on the company, just the financial needs. So the days between the actual initial, and when we say primary financing, that's just actually a preferred share financing. So you can see that it kind of spans longer over those periods. So common mistakes and misconceptions. The first one is, like we kind of alluded to, founders underestimate the time that it actually takes to raise the capital. So we definitely suggest starting the conversations early. It takes months and months to develop a relationship with an investor that you'd want to work with long term and build that relationship. We've seen, kind of Ryan's mentioned, instances where investors really like the tech, but they're actually, given the way that the cap table has been construed or prior investments, et cetera, they can't actually invest for that reason because they don't feel that the founders are properly incentivized to build a business. The next one, founders do not fully understand the cap table implications. Ryan already kind of nailed this one as well. Lawyers should be able to help you kind of understand the implications of those valuation caps or any discounts, et cetera, and have an idea of what this may look like and how you're, as a founder, your dilution may suffer. Expectations for valuations are either too high or too low. So it's important to remember that valuation is not everything. We actually have founders who will comment afterwards and indicate that they wish that they hadn't taken such a high valuation. And the reason for that is because it makes it difficult to then actually exceed that valuation in the next financing, such that when the time comes to actually raise capital, it poses a down round, right? Like a valuation that's less than what the prior round would be. So it's just important to actually think kind of in totality and in terms of the 5, 10, 15-year plan of this company, and not necessarily be as focused on the numbers, while still understanding the pro forma and the cap table and how everything models out. Founders may take a short-term view on governance and key shareholder rights. We've kind of talked about this at length, but who's on the board, who's the leading shareholder, what do I have to do to get approvals? What do I have to actually obtain, or what conversations need to be had in order for me to affect this, whatever that action is? So it'll be really important to kind of understand governance and the key shareholder rights, as once the financings have closed, it kind of sticks. There may also be a poor fit between the company and the investors. So again, like a lead investor will generally take a board seat at the time, especially in the A. So it's important to remember that that investor will be with the company, and it's very difficult to remove thereafter. Sometimes, an investor will agree, for the greater good of the next round. They'll say, look, like I put in a small check in an early stage round. I have the company has another investor that is very interested, but they're conditioned upon me actually like stepping down or that board seat becoming vacant. Oftentimes investors will be reasonable, but again, you just want to make sure that there's actually that good fit and that you can have those open conversations with the investors and the board seat if that's applicable. And then just again, like make sure you choose counsel carefully. These are supposed to be your advisors. Areas that we focus on are obviously to be responsive, supportive, have that kind of sounding board to bounce ideas off of, and just make sure that you're not afraid to ask questions. There are no stupid questions. And you really want to make sure that you can have an advisor that you can really trust and a counsel that you can depend on to actually, help you understand the implications of the financings.
Great. So we're happy to take questions. There's 10 minutes left and we kind of budgeted that. If not, we have kind of an overview of kind of Canadian market venture term and kind of our deal study. So I don't know, Michael, it doesn't look like there's any questions, but we give people a second if they have any. Otherwise, we're happy to jump into this for the last kind of 10 minutes.
Yeah. So sure. If anyone has any questions, feel free to type them in. I thought I could maybe ask a question or two though.
Please do.
One is, I know some people who are here or maybe will view this are those who have maybe developed or are developing their technology while they are at an academic institution or maybe at a hospital, something like that. I think you already gave some guidance, maybe in general, if you're working somewhere on how to approach developing your company. I know in some cases they will have, it's inevitable, or maybe they can't avoid the fact that they are working and using either resources or maybe even developing part of their technology at that institution. So do you have any kind of common mistakes or issues for for those kinds of situations?
Like, I think you just want to be very transparent and you want to document everything. Like, your investors are going to be very sophisticated, and the second they find out that, you know, you're a doctor or you were a PhD grad student or you were a professor at kind of a university or had some sort of affiliation with a hospital, they're going to start asking questions like, okay, can I see your employment agreement, or can I see the student handbook in terms of the ownership? And so, like, the great thing is, like, a lot of these universities, especially kind of based in Toronto, they'll have tech transfer offices that kind of do this on a daily basis and understand it. But I think just educating yourself on what the policies are in terms of what I own versus what they own. Like, if you're doing research in a lab, and it's part of, you know, your residency, or it's part of, you know, some other aspect of your job, you know, can you commercialize that? If you commercialize it, what would that look like? Like, have a conversation with the tech transfer office. Like, you don't want to be having those conversations when you have a term sheet in hand and your investor starts asking questions. Be like, prove to me that you own this, and I want a letter from your university, or want a letter from your hospital that basically indicates that you have ownership with respect to this. Like, you really have to be proactive about it. And we have some founders who, like, from day one, they're like, I'm developing this, it's related to some other work that I'm doing, but I am, you know, here's the receipt for the computer that I bought, and here I could show you that I'm doing it, you know, I'm logging the time that I'm working on this, and I'm working on this from like 6 p.m. until 9 p.m. in my own personal time, and I'm not using any devices, and I'm not using this time. And if I'm, you know, communicating with other people, like, we're doing it in separate channels. We're not using our hospital email addresses. We're using our personal email addresses. And the more kind of proactive you could be with respect to that, it's going to save you a world of hurt kind of on the other end of it. And also, a lot of the places, like, if you're a grad student, very often, like, you could go to the faculty and you could actually get a letter where they say, like, look, we understand that, you know, Mary is working on so and so, and that she is doing this right, and then we have no kind of claim with respect to ownership. Like, if you could have a letter like that, like, that's like the best thing, because you could say to your investor, look, I thought about it, here's the letter, and like, it shows that I have complete ownership with it, and I've documented it, and here's like my plan of how I segregated what I'm working on. And that's what you want to do. Like, to the extent that you could come to that conversation, show that, and have everything documented, it's a lot better than just praying that they're going to sign it when you have, you know, someone willing to put $2-3 million into your company as a condition to getting that. So it's good to be proactive.
Yeah, thanks for that. Yeah, it's makes a lot of sense. Maybe just one more question. You may get to this in your last slides, but I know, you know, anyone that's been trying to raise money now talks about how much more challenging it is. So I think my question is, with respect to the general increased challenge in the current climate, but maybe if there's also anything particular you'd want to say about the Canadian VC market. You know, are the challenges kind of reflected mainly in, you know, I know there's maybe less capital to access, but is it also around investors are harsher on valuations? Are they requesting more in terms of, you know, certain kinds of terms that you went over, especially in Canada? Like, do you find that there's been a change in maybe the philosophy or
It's
flexibility investors?
it's a good question. Like, if you were to take a look at what the Canadian ecosystem consists of, about in our deal study, so the deal study we just published, it's about 78%. I think CBCA reports about 80%. Like, 78 to 80% of all the financings that are completed in Canada are seed to Series A financings. And those are usually the ones that are kind of more immune because they're longer term bets, right? Like, if you're doing that first financing round, your kind of projection until you get some sort of liquidity, the sale of the company, an IPO, or some other exit event is way down the line. And so there's a lot more flexibility with respect to it. Are we seeing significant changes in terms? I would not say so. So one of the things that we look at in our deal study is kind of what are the standard terms that people are transacting on. And by and large, the vast majority of transactions are still a 1x liquidation preference, which means on an exit, you get back the better of the amount of money you put in or what you get on an as converted to common basis. You know, non-cumulative dividends or no dividends associated with it, non-participating preferred, pari passu, which means that, you know, they're at the same level as the other preferred shares. They're not coming in senior, and non-redeemable are kind of consistent terms. In later rounds, you're starting to see more kind of investor-friendly terms. And so in that instance, maybe a more investor-friendly term is the new security is senior, or maybe it has, instead of getting 1 times its money back, it gets 1.5 times back its money, or there could be a participation feature. But we're also seeing, you know, one of the key features that we saw in 2023, as opposed to in prior years, is there's a higher incidence of down rounds. And so Jen had mentioned this earlier, what's a down round? If you raised at $2 in your last financing round per share, and the new financing round is at $1.50, well, that's a down round because the price per share has gone down. And in instances where there's a down round, you usually see a higher proportion of these investor-friendly terms kind of creeping into financing rounds. And so, notwithstanding the fact that there are fewer rounds taking place, that the aggregate amount of investments that are taking place is lower, as you can see from this chart, right? If you were to take a look at the high from 2021, like there's a significant decrease in kind of the total number of dollars being invested in financing rounds. Although for the most part, if you discount 2021 and look at kind of pre-COVID, we're still doing really well in the early stage financings in terms of dollars invested as well as kind of number of financing rounds. The terms are more or less the same. In terms of what's changing is investors are far more concerned about diligence. So someone may have cut you a check beforehand, like they're kicking the tires for a lot longer period, and they're doing more diligence to get comfortable with it. They're more focused on when are you going to come, revenue positive, and they're checking kind of key metrics. Like, we're in 2021, some people may have been more inclined to kind of take a flyer on a company. Investors are kind of more savvy, and they're kind of doing their diligence with respect to it. And then the other kind of major trend is, every company has some sort of AI component associated with it at this point in time. Like there's your pure AI companies, which, in our deal study, I think in 2023 represent about 15% of all financings that kind of took place over the course of the deal study, about $500 million worth of the financings. And so you have like your pure AI companies, which are like large language models or some specific use case. But we're also just seeing people deploy AI kind of across all different industries and different verticals, et cetera. It's kind of like a key component. Like it's one of the questions that all investors are asking these days is like, what's your AI strategy kind of in connection with your financing? Yeah.
Great. Yeah. Well, thanks for that. But yeah, I just want to say, first of all, thanks for everyone for joining. And thanks so much to you, Ryan and Jennifer, for the great presentation today. It's once again really informative and great content that we received for this session from the team at Osler. So we'll be looking forward to sharing this with other startups in our network and entrepreneurs who are interested in the space. So I know you provide information, and it sounds like people either through us as Osler, as one of our partners, can get in touch. But certainly for anyone on the webinar or viewing it later, if you do have other questions or information that you think is relevant, please do feel free to reach out to us. So thanks again for that. Great talk.
Thank you for having us today. Take care.